The average new car in the United States right now costs around $48,000. Because very few people pay cash for a transaction that large, it is almost universally financed, typically stretched out over an 84-month loan term. That math results in an average monthly payment of over $700. That $700 is only the baseline. Lenders require you to carry full coverage insurance on a financed vehicle, which easily adds another $200 to $300 a month. Once you factor in fuel, regular maintenance, and registration fees, the monthly burden climbs significantly higher. This pie chart illustrates the monthly budget of a median income household. When you combine those transportation costs, they consume 25 to 30% of a family's entire take-home pay. It leaves shrinking, inadequate fractions of their income to cover housing, food, and retirement savings. The math is objectively unsustainable, yet roughly 85% of all new car buyers in the country willingly take on this exact financial obligation. This nationwide financial drain results from a highly optimized corporate machine deliberately designed to extract maximum money from consumers and keep them in perpetual debt. To understand how this system was built, we have to look back to the 1920s. The auto industry faced a distinct operational problem. Mass production lines produced a massive volume of vehicles, but requiring buyers to pay the full purchase price in cash severely limited who could actually buy them. General Motors found a structural solution. They created GMAC, an internal financing arm designed specifically to offer installment payments to consumers who lacked the upfront cash. Under the leadership of Alfred Sloan, this executive decision allowed the company to bypass consumer affordability limits and keep the assembly lines moving. It also deliberately altered consumer psychology. Instead of asking the logical question, "Can I afford this total price?" buyers began asking a much easier question, "Can I afford this monthly payment?" Once the monthly payment became the metric that mattered most, automakers stopped competing primarily on the total cost. It gave the industry unlimited flexibility to stretch out loan lengths and manipulate interest rates, hiding the true financial damage of the transaction behind a digestible monthly number. Inside a modern dealership, the Finance and Insurance, or F&I office, functions as a highly trained profit center. The person sitting across from you is a specialist whose job is to extract additional revenue from the transaction after the car's price has already been negotiated. By the time you sit down to sign the paperwork, you are mentally exhausted from hours of negotiating. The finance manager exploits this fatigue to pitch high-margin add-ons like extended warranties, tire protection, and gap insurance. The tactic used to sell these products is remarkably effective. A package of add-ons that inflates your total debt by $3,000 is framed simply as a trivial $34 bump to the highlighted monthly payment box on your contract. Those hidden costs collide immediately with a severe financial accelerant, aggressive vehicle depreciation. A new car loses roughly 15 to 25% of its value in the first year alone, and up to 50% of its value over the first 5 years. Look at this graph tracking a $45,000 car on a common 72-month loan. The steeply dropping bottom line represents the plummeting resale value of the vehicle, while the gently sloping top line tracks the slow paydown of the principal balance. The math breaks down entirely right here at year 3. The average American decides to trade in their vehicle around year 3 or 4, long before their 72-month loan is actually paid off. Because the vehicle depreciated far faster than the loan was paid down, the buyer is underwater. That red gap represents negative equity. They owe thousands of dollars more to the bank than the trade-in vehicle is worth. Dealerships seamlessly solve this problem by rolling that negative equity directly into the loan for the next car. You are now financing a brand new vehicle, plus the leftover debt of your last vehicle stretched over a new 84-month term. The system guarantees you never actually achieve outright ownership. The damage goes far beyond the immediate loss of a single vehicle's depreciation. The true severity of the car payment trap is the invisible wealth that is systematically destroyed over a working career. Let's use a conservative monthly car payment of $600. Redirecting that exact amount every month into a stock market index fund yielding a historical 8% return changes the trajectory of your life. The flat baseline represents steady $600 monthly deposits, but look at the total portfolio value curving aggressively upward over a 40-year career. Factor in capital loss to mandatory insurance and negative equity, and the true lifetime cost easily clears $1 million. By diverting consistent cash flow away from compounding assets, the car payment system siphons the lifetime retirement security of the middle class into the profit margins of the auto and finance industries. Opting out of this cycle requires choosing vehicles based on current financial reality rather than marketing, saving cash to purchase a reliable 3 to 5 year old car outright. Buying in this specific age window gives you a massive financial advantage. The original buyer absorbed that devastating 50% initial depreciation hit, leaving you with a stabilized asset that you own entirely free and clear. People often hesitate because of the reliability myth, assuming older cars will drain their savings in repairs. But modern vehicles from reputable manufacturers are engineered to last well past a decade. An occasional $1,000 repair is statistically much cheaper than guaranteeing yourself a $700 monthly payment. Executing this strategy is difficult because the cultural pressure to signal success is intense. A pristine, financed vehicle parked in a suburban driveway is a highly visible American marker of having made it. But financial reality does not care about social signals. Often, those expensive cars and driveways are primary indicators of cash flow poverty. Choosing to drive a paid-off car is one of the most effective ways to stop funding someone else's profits and start building millionaire-level wealth.